Welcome to the Salty Investors, episode number 63. It is January the 25th, 2024. Another year, Tim. What's your New Year's resolution? Got any?
Oh, well, I'm going to talk about that a little bit, but yeah, not much. Just glad to make it, I suppose.
Yeah.
Market
Still
hasn't
alive?
totally collapsed. Yeah, the market's still going and yeah, still alive,
Oh.
still ticking along. The world hasn't ended. So what about yourself?
Yeah, it's about it. It's all I can ask for these days. Just to still be kicking. Yeah.
Good.
So let's get into so of course we've been off for a month and the salt has accumulated. I've got a salt mine outside, the amount of salt I've got. So I'm going to kick it off with our stunning and brave government are going to have an inquiry into the supermarkets conducted by the ACCC. Now, the Treasurer, Jim Chalmers, who has a bachelor's degree in communications, is going to direct the ACCC in its inquiry. And this is what Jim had to say. For me, it's this simple. When farmers are selling their product for less, supermarkets should charge Australians less. Well, I guess for people like Jim, i.e. the financially illiterate, it is simple because the price supermarkets charge, of course, is only influenced by one single factor, what they pay farmers. I mean, forget about transport costs or, the cost of maintaining stores and paying your staff. I mean, forget about all that. I mean, if you're paying the farmers less, then you got to charge the customers less. I mean, tell me you've never run a business without telling me you've never run a business. Of course, all this is smoke and mirrors to make it look like the government is actually doing something, when anyone with a brain knows they're completely impotent.
Yeah.
What do you think?
It's got really bad the last few weeks. It's like, it's both sides of politics now, in for the boot.
Yeah.
What's the ACCC going to come back with? Oh, yeah,
Well, no.
I know 2.5%. Like, is their net margin or some crap? It's just
that's so. I couldn't squeeze everything I wanted to in 1 minute soundbite there, but I mean, let's just go over the fact that in 2023, financial year 2023, Woolworths' NPAT margin was 2.5%. In 2021, it was 2.9%. So their NPAT margin's actually gone down from the pre-inflation period. Coles 2023 NPAT margin 2.7%, last year 2.8%, 2021 2.6%. I mean, so basically their margins really haven't changed much at all. And they're not going to find anything. I mean, and there's so many moving parts, like fuel costs going up and down. I mean, and they're raising minimum wages going up. All this. I mean, the ACCC is not going to find anything. The politicians will pat themselves on the back because they held those big supermarkets to account when actually it's all window dressing. It's just bullshit.
Yeah. I joke about that the ACCC is going to come back and say, hey, their margins are too low. They need to lift it and make a little bit of extra profit.
Yeah, exactly. You're giving too much away, fellas.
Yeah. But it's just a smoke and mirrors thing, just political nonsense. Everybody who understands finance knows, well, if you like it so much, just get into it, but you're going against Amazon, Costco. Imagine going, oh, yeah, we're going to go up against Costco. It's just ridiculous type talk. So I don't know.
Yep.
It's just popular at the moment, I guess.
Okay. What do you got for us this week?
The stage 3 tax cuts are going ahead, which is good news, even if they've been adapted. Last year, I made a commitment that if they go ahead, I'll lift my game and try to offer more to the community. I've been concerned for the last 6 months I won't be able to lift my wage to $200,000 a year. And I still want to stick to my commitment. Albo's made it easier for me now. Now I only have to lift my game to $150K a year. I'm feeling relieved, but surely this isn't healthy for society. It's going to put a cap on productivity. I wonder how many others are not incentivized to do more. That's what I'm sort of. I'm not upset about. I'm just grateful that we're getting a tax break. All the other, these people are complaining. Oh, I was surprised that he did it at all. But
I think again, this is like in what my segment was. This is just a political calculation because they know. Mm-hmm. They know they really can't do anything about the cost of living crisis. They've got these stage 3 tax cuts, which are unpopular with the resent-filled class, which is their base. It's a good part of their base. So what do? Well, we will wedge the LNP because we will deliver tax cuts. We just won't deliver the ones that they want, and we'll give the people, that need the tax cut the most.
Yep.
Apparently, the people that don't pay any tax at all usually, we'll give them a tax break rather than the top end of town. So it's a political calculation and a good one. I mean, I think it's a good move politically, but I mean, wouldn't it be nice if we did our tax policy based on what's good for individual taxpayers rather than fucking politics? Wouldn't that be a nice change?
And the opposition swallowed it whole here, and they think they're going to go to the polls.
Oh, yeah.
They're going to lift everybody under $130,000. Going to lift their taxes. Like, it's obviously they're not going to do anything. It's just talk.
I said to someone yesterday, Susan Lay came out and go, "We're gonna reverse these tax cuts." Oh yeah, you're going to make people pay more tax, are you? Is that what you're going to do? And today she's out backpedaling, of course.
Yeah.
Susan, it's not like it's the first time Susan Lay put her foot in her mouth. Just dumb. I mean, so it's a good move politically by the ALP, but that's how we want to make tax policy, isn't it? Just to see if we can wedge our opposition somehow.
Yep. That's right. Yep.
Yeah. All right. Well, a few things have happened since we've been off, and it's all good news, Tim. You should, if we ask Stephen Koukalis, the Kouk, we'll get to him a bit later. The NAB survey was out Tuesday, was it? I think it was out this week. This is a pretty widely followed business survey. So you can see the business confidence is crumbling. Now, you might think, that's a kind of a fuzzy thing because it's measuring people's sort of subjective views, but it does have it does lead. So you see here, business confidence, this graph, it's been pushed forward 2 quarters.
Mm-hmm.
You see it correlates pretty well with downturn in actual business investment. Correlates, it's not bad. It's fairly decent correlation there. And it's gone negative just sort of late last year. So that's not looking that great.
But the interest rate cuts are coming in now. So
well, yeah, I mean, we're going to get to that. Trading conditions sharply lower at the end of the year.
Mm-hmm.
That as on that graph. So GFC was worse, obviously. COVID was worse, although I like to discount COVID because it's not a real economic event. It's just a outlier. And so this led to Kouk. I don't know if you followed him, but I mean, have you ever looked in the feed of his Twitter feed? I mean, everyone just takes the piss out of him because he's like so wrong most of the time. And so he basically, his little video, he said that this opens the door to he didn't say they will happen. He said it opens the door for the RBA to cut rates in March. I just want to remind. Can you remind me what the cash rate is again?
I don't know. It's above 4.
4.3%. Now, inflation, as we will see in a minute, is, of course, it's crashing everywhere. It's coming down, but it's still over 4%. Doesn't matter if you use the core inflation or the whole shebang measure or the trimmed mean. They're all still over 4%. You've got a cash rate at 4.3%. I reckon it's going to take a bit longer than that, unless we just fall off a cliff or something.
Yeah.
But the Kouk, I'm going to keep track of the Kouk because he's just great comedic value, I think. We'll keep track of him this year.
So what's the consensus? Is it 2 cuts this year or is it 4? I'm hearing, 2, 4. I'm hearing it all over the place. So
yeah. I thought 2 was consensus, but I don't know if that's changed or not.
Mm-hmm.
I remember last year my famous prediction was that unemployment would hit 4%. It didn't, Tim. It stayed at 3.9 for December. We got the data last week. So epic fail by me. But the number of unemployed people did rise 15% during the year. And the number of employed people only rose less than 3%. If you have a look last year, the number of unemployed people, you could basically reverse those 2 numbers. The number of employed people went up double digits and the number of unemployed went up single digits. That's been completely reversed. And I think, look at those business indicators. Look at the last GDP print, which was September quarter, because we're terrible at doing our accounts in this country. It takes us so long. That was a negative GDP per capita print. We had a year-over-year rate of 2%. It's probably going in the opposite direction. That's the inflation numbers. Like I said, all those measures, the monthly, the annual trim mean, the CPI excluding volatile, it's still over 4. It's between sort of 4.2 and 4.5 with a cash rate at 4.3. So I don't know that you'd be getting too excited yet about rate cuts. But I mean, the Kouk, eventually he'll be right about something. So maybe this is it. Maybe it's the big surprise we've all been waiting for.
Well, you got to hope, I suppose. A lot of people hoping that it's all going to come off. So I can't. Yeah. Good luck to him if it does. But
yep. So before we get on to the stock of the week, car sales, I was going to say, Tim. Now, last year you sat on the sidelines. I mean, look, we've got rate cuts coming.
I know.
We've got tax cuts. It's just $25 a week for people who've had $100 a week rent rise. I mean, this is going to make all the difference, isn't it? I mean, we've got rate cuts, we've got tax cuts, we've got pent-up demand. Why aren't you completely fully invested, Tim? What's wrong with you? Where did you go wrong?
Well, I probably should have allocated, in October last year a little bit. Should have had a nibble then. Got a bit too greedy. But yeah, I just don't think it's going to come down that quickly. I'm with you. Like, it's going to stick around here for a bit. And then what's the market going to do? When we go through halfway through the year, if we haven't had a rate cut by then, I think the market's going to panic a little bit. The VIX is like 13. So there's just nothing happening at the moment, unless you've been in the magnificent 7.
I just left off. The S&P 500's at new highs.
Yes.
New highs. Come on.
And
it's S&P 6,000.
Yep. Japan's doing well. Everywhere's doing well. I think besides the UK, but
and China property in free fall.
Yeah, well, I think my Alibaba, supposed to be in now at $65. I don't know. We'll see where that happens, but none of the value, the quality stocks we've been looking at, none of them have crashed. So that just proves that quality is just resistant to this sort of stuff on the early cycle. That's what I'm learnt now. Quality is great in the early cycle, but you have to go back to value if it really goes bad here. So maybe I haven't got enough value picks in my stock list. So what are you thinking anyway?
That's why I asked you, because I've got no excuses, and I thought if you had one, I could borrow it off you.
Yeah, it's not looking good.
Look, actually, in hindsight, you said you should have taken a nibble in October 2023. Actually, October 2022 would have been better, I think.
Yeah.
S&P was. That's with the benefit of hindsight. But yes, I mean, you can't look at the market, whether you're looking at the Australian market, but particularly the US market, and call it cheap or good value. It's all pretty much reliant on a kind of Goldilocks outcome, no landing, not even a soft one, and everything's fine and dandy. I find that hard to believe, but hey, I've been wrong for a while. Maybe I'll continue to be wrong. I'm gonna wait and see. Who came out this week? Baby Bunting came out with a update. Their sales are still down, but they're hanging in there. They're not getting any worse. So it hasn't completely fallen off the cliff. Look, I don't know. No, Tim. Fiscal stimulus is on the way.
Well, remember, I'm a bag holder at the old Magic Bean currency, so it's done pretty good for me. Was 150% last year. So that's what I said. I'm sort of hedged a little bit. Goes with me against me. I'm, sitting pretty. But I would have liked to have allocated a little bit better. So bit of a disappointment.
Yeah.
But the big names aren't really allocating big. They're not swinging. Buffett and all these other guys. I don't see them swinging besides Occidental. So I don't feel too bad.
Yeah. All right. Well, let's have a look this week. We got another one. It is an Australian quality, I think we can call it. We can call it quality, can't we? Let's have a look at it, Tim. Car sales.
Yes, Car Group is runs a popular Australian website called carsales.com.au, which most people understand. It's basically an auto platform to sell cars. This is similar to realestate.com.au, the REA group that we did a little while ago, but it's obviously a lower ticket item, and it's less sticky as users have other options. For example, Gumtree, Facebook Marketplace, which are basically free.
Yep.
It's still a great business as it offers users and dealers great value compared to these other free platforms. They've expanded into the USA, Brazil, and Korea, purchasing winning platforms over there. They've proven that they're able to acquire and add operational value, especially via their dynamic pricing and adding more options to the menu. One expansion area that interests me is they have added finance to their list of options. I think they're in a great place to offer this. If they partner with a great financial provider, I see little downside as the default risk is taken away from them and they'll still keep all the revenue and have high margins. Let's look at the fundamentals. They are diluting, but they do acquire assets with that dilution and they have a track record of converting. Employee headcount is well under revenue growth over the last 6 years. On a PE basis, it's fairly well priced on historical terms. On a price to free cash flow, it is expensive. Return on invested capital is lumpy as they acquire targets, but it would be in the mid-20s if they didn't acquire. So if you take that out, margins are insane, showing they have huge pricing power in the market. Growth is insane, especially even on an EPS basis. But you've got to remember, COVID mania is distorting these averages up a little bit.
Yeah.
It's got a nice dividend and payout ratio. Again, they need to ditch the dividend as it's destroying capital compounding. But a 30% payout ratio isn't 33% payout ratio isn't terrible. Interest coverage is okay, but they should be doing a little bit better just in case they run into slow times. Let's flip over to the balance sheet and cash flow. They have $1 billion in net debt, mostly long term. They have about $250 million in free cash flow, so they could pay off this debt in 4 years if they drop the dividend. I have this down as cyclical, as less cars are normally sold in a downturn. But they grew 108% from 2007 to 2010, which is about 26% per year in the GFC, given that Australia didn't really have a GFC, but we still had a bit of a slowdown. Australia is similar to the US. You need a car to get to work. Even in a downturn, a car is classed as essential. There'll be some second and third cars in a household that'll be sold to pay to get cash, and car sales gets a clip of that. So can I really call it a cyclical? At a price to free cash flow of 45, and if we start averaging the growth, ignoring the COVID years, I'll get about 10% growth going forward. So I should be looking at about in the mid-20s for a price to cash flow. In 2017, it was 21, so my target is fairly realistic. Analysts have revenue dropping on average about 9% per annum over the next 3 years, and dilution is a bit much for me to stomach. Auto Trader in the UK is great also if you like this segment, and they're buying back stock. They have low debt, price to free cash flow of 24, and great return on invested capital and margins also, but the growth is only 8%. What do you think of car sales?
You just said revenue growth declining 9%, or you mean declining to 9%? So it'll be...
Yeah, so it's 9% per annum, I think.
Okay.
But that's just what analysts, they've got no idea. So, who knows? But I think that's what the market is sort of seeing at the moment. And,
see, there seems to be I don't know what's going on with those numbers there. I'd have to take a closer look, but you've got your price to cash flow ratio getting more and more expensive, whilst your actual PE is coming down. So that sounds like, your cash generation is weaker. Is this because of buying acquisitions, isn't it?
Yes,
yeah.
I think so. Yeah.
Yeah.
So on an equity basis, it's looking, quite good.
Yep.
So, but you can see there the return on equity numbers are, they're solid basically the whole way through.
Yeah.
So there's only they don't drop as badly. But yeah, just the metrics I sort of look at. You know, I'm a bit old fashioned. You know, like cash flow. So
Yeah.
yeah. So, you know, but when I look at that, I'm just like, nah, I can't do it, you know, because I know I'm going to get hurt here if I'm, but, you know, that could be just a bad quarter, you know, they're going through.
Yeah.
They're trying to eat down a few investments that they've got into. As you can see, look at those revenue numbers, like that's insane. Like,
Yeah.
and they could continue to do that. There's a heap of Baltic states that got these little car online platforms that, you know, are the leading, you know, and you chuck a couple of billion of that, you buy that and you buy the revenue. And if you've got operational efficiency, well, yeah, keep doing it. But
yeah, as long as you can keep that, because you don't want to end up like, you know, ABC learning centers, you know, or who started off with like they had returns on equity of 25%, great little small business.
yes.
And then they just took on more and more debt and issued equity. And you know, by the time they went bankrupt, I mean, they're officially in the accounts, which I think were a bit dodgy. I mean, their return on equity had gone down to single digits by the time they went bust, you know. So as long as, I mean, if you can keep stacking these acquisitions on and you can keep getting the operating leverage out of them, doing what you do, then good. I mean, at least acquisitions, I mean, you know, we're fussy. We like to see organic growth rather than acquisitions. But I mean, it's not like they're buying, it's not like some diversification story where they're buying things they don't have any specialty in. They know exactly what they're doing here, right? They've got a track record in doing it.
Yep.
Yeah.
And then dynamic pricing is really smart. Like, I was surprised. I thought, you know, these guys just take a clip and that's it. But these guys, you know, have got segments like luxury and, you know, postcode, you know, they hit you on different, like they're really clever on what they do. And then obviously other sites overseas don't do that. They just hit a standard rate over the board, and then they just come with their dynamic pricing, and, you know, they don't see any drop in volume because, you know, if you're selling an expensive car, you want to advertise it. You know, you don't care that you're paying an extra couple $100, but you're selling a, you know, little crap box. You know, you don't want to be, you know, so makes sense. Just one that I've never thought, oh, I'll just stick to realestate.com.au. Thank you. You know, like, but, yeah.
No, well, it's the kind of thing where because if you think about cars and car sales, you know, think about the car industry, it's all very low margin, it's very capital intensive. You know, but it's not that. You don't have to have a yard to put all the cars. You're just a platform. And yeah, it's actually really great, and they've got that. I mean, certainly in Australia, they've got that first mover advantage. I mean, who's going to push them out of that spot in Australia, in this country? So it's worth watching. I guess I'd have to do more work to find out what it's worth paying. You know, why the numbers are the way they are. Is it because they're digesting acquisitions at the moment? Because what you'd like to see is it's digested, and now we've got a year later after, and we know what the returns are in these different markets, and by that time it's probably too late.
Yes, that's right. Yeah. So, but winners keep winning. That's what I keep trying to tell myself. And you know, one of these will crash hard if we do get a correction. Like, their revenue number is going to like freaking drop off a cliff here, like for the first part of it, and people are going to run like this. They're going to escape from something like this, like they did in the UK, like it's happening now in the UK. So if you don't know about it, it's very hard to invest in those times. So do your homework, and get a chance, you might buy it.
All right, there you go, people. Tim's brought the goods with Car Group, which is carsales.com.au. And we will see you next week.